This is a classic one, buy and hold and SIP Karo Bhool Jao. We have been giving this mantra for the last 25 years since mutual fund industry came into existence. And since then we have been saying buy and hold, buy and hold, buy and hold. But the statistics are revealing that investors stay invested in equity as an asset class for not more than 2 to 3 years. Only 2% of the investors stay invested longer than 10 years. If this is the statistics, why are we not introspecting and saying, where are we going wrong? You know, Mukesh Ambani made a very beautiful statement saying, finding problem is more important than finding solutions. If you find the problems which are relevant in your industry, my problem in this industry is that we are giving this mantra saying, I told you to buy and hold. You did not listen to me. Now you're booking losses at the worst possible time. I cannot help you. Your help was required not to get into that downward zone, but protect that downside was our job as an advisor, give optimum risk adjusted return and not maximum returns. So let me explain to you the basic principles of Mr. Bond's exit theory. I'm just talking about the theory. You want to select your own data points or the own metrics in terms of what should be your red zone, yellow zone and green zone. My red zone and yellow, my selection of the matrix is based on Nifty, PE, PB and some more masala into it. Motilal Oswal Valuation Index has Nifty, PE, PB and dividend yield. ICICI Prudential Valuation Index takes into account price to book ratio, etc. So you may want to create your own algorithm. You may want to follow any one of these algorithms. And based on that, the two basic principles which you need to add in your advisory practice is downside protection and being in the right asset class at right valuation. And how will this work is what I'm going to discuss just now. I have been saying that we are creating Abhimanyus on a daily basis who is stuck in a Chakravyuh, not knowing when to exit or do profit booking. If somebody comes to Mr. Bond, that particular investor or that advisor knows upfront what strategy. Or even before onboarding your investors so that neither do you get carried away with your own emotions and biases, nor do you let the investors get carried away. Our job is to manage emotions. Wealth management and the stock selection and timing of when to get into which sector, etc. is the fund manager's job. If we do our job properly and correctly and diligently, half your battle is won. As they say, 92% of your returns are from asset allocation, only 8% from stock selection and market timing. What is the correlation of Tin Patti to mindset of investors? All of us have played Tin Patti during Diwali, practically on a yearly basis. When you go with 10,000 rupees, you make 5,000 rupees on top of that. What would you do with that 5,000 rupees? Invariably, you give that 5,000 to your spouse and say, I will only play with 10,000 rupees. What is your mindset? Your mindset is not to play around with your profit. Your mindset to book that profit, take it home. Your mindset is no different from the investor's mindset, because we, at the end of the day, are also investors. We may be advisors, but we started being investors first and then got into the advisory mode. All our mindsets are investors' mindsets. And our mindset is that I must have profit booking, take my profits back home, then I'm very comfortable. When we know this mindset and we ourselves are privy to that mindset as investors, then why are we not incorporating exit strategy in our investors' portfolios? All of us, harder you fall, longer it takes to recover. For the markets to go down from 10,000 Nifty to 5,000, it is a 50% drop. For it to go up to 10,000 Nifty, it is a 100% rise. That means from 10,000 to 5,000 and back to 10,000, you have only broken even. You have not gone into profit. But if you would have made sure that you safeguard that inbuilt profit by taking it out of the system and then taken the journey forward. If the drawdowns are lower, the bounce backs will be faster. All of us are aware of that. If I have fallen from 10,000 to 5,000 versus somebody who has fallen from 10,000 to 9,000, who do you think will climb the mountain peak faster and sooner. Naturally, person who has only fallen 1,000 points versus person who has fallen 5,000 points. This is the basics of investing and protection of downside. And based on that, what should be our strategy? Sorry. You know, we are getting unnecessarily into a maze of large cap, small cap, mid cap, multi-cap, duration, credit risk, etc. Unfortunately, nobody's following that straight line, which is that red line, which is the simpler line, more effective line, instead of getting into that maze, and that is nothing but asset allocation. Either you do asset allocation on your own, or you do investments through dynamic asset allocation schemes, or you create what I'm going to just discuss in the next few slides. How do you switch between different asset classes based on the market valuation? This is my quotable quote. If you respect markets, markets will respect you back. If you ignore fundamentals, markets will give you a reality check. Every second or a third year, we are getting a reality check, but we are not coming out of our own mistakes. We are repeating the same mistakes again. Buy and hold, SIP Karo Bhool Jao, do not time the markets, etc., etc. Select two asset classes. One is the aggressive asset class, which is your equity as an asset class. But for a senior citizen, your aggressive asset class can be a dynamic asset allocation fund. And select a conservative asset class, which can be liquid fund, equity saving fund, or a balanced advantage fund, or the dynamic asset allocation fund. The choice is entirely yours. Our intention should be to move from aggressive asset class to a conservative asset class when the markets become expensive. Either you do it on your own, you do it through some strategies, or you create inbuilt. I have my own investment solutions which does this on a trigger basis. But what I'm trying to showcase to you here is that you can create your own strategies based on a conservative asset class and an aggressive asset class. This will ensure downside protection when the markets become expensive and we get into a red zone category. All you have to do is move those assets, which is the equity as an asset class, into a conservative asset class. So at that point in time, dynamic asset allocation funds may be at 30% in equity or 40% in equity. Individual dynamic asset allocations funds in different AMCs may be following different models and metrics, but at least you will move away from most expensive and the most aggressive asset class and the most risky asset class at that point in time to a conservative asset class. Which scheme in which bands? You create these bands yourself. Ideally, as I've shown you, 90% of the times you have earned more than 10% returns in yellow zone. So that means in yellow zone and in the green zone, you should be in equity as an asset class. And in the red zone, either DAF or liquid fund or equity saving fund, the choice is entirely yours. I would prefer dynamic asset allocation fund for a simple reason that July 2017, when we exited out of equity based on our own algorithm and got into dynamic asset allocation fund, would I have been able to manage the emotions of the investors if I would have taken him to liquid fund from July 2017 to March 2020? Answer is clearly no, because perceptibly for the investors, the Sensex numbers were only growing during this period. But underlying all the assets were bleeding, as all of us are aware, except for large caps, few stocks. So that's the reason why I select dynamic asset allocation fund. If the markets would have remained irrational for the next 5 years, at least it would have done buy low, sell high on a constant basis and at least generated equity kind of returns, even in DAF kind of schemes. That's the reason why I'm selecting DAF versus liquid fund, because you and I will not be able to manage the emotions of the investors if the red zone remains for longer periods of time. And as I've shown you, red zones stay in that period, the markets stay in the red zone period for maximum amount of time.